And yet, when we witness what has happened as Prime Minister Carney has made it clear that he no longer sees a future based upon hemispheric priorities for all of us, but instead, he now will look more and more to Europe. I've never met anybody in my career that was upset with Canada as a great friend of the United States.
The moment that changed the hearing was not a shouting match. It was hesitation. Jamieson Greer entered Congress prepared to defend Trump's tariff strategy as proof that America was winning against Canada and other trading partners. But as lawmakers kept pressing him on rising consumer prices, supply shortages, and industrial costs, the argument started collapsing under its own contradictions, because the numbers are no longer lining up with the political slogan. Instead of isolating Canada, Trump's tariff pressure is accelerating Canada's global repositioning. Instead of forcing Ottawa into retreat, it is pushing allies and investors to treat Canada as the steadier long-term partner. And inside the United States, the economic pressure is no longer theoretical. Americans are now seeing the costs show up in construction, energy, food, manufacturing, and even basic consumer goods. That is why the mood in Congress suddenly shifted. Not because Canada beat the United States overnight, but because Washington is starting to realize this strategy is becoming expensive to sustain.
If I were to ask today, what is America's trade policy, I don't think anybody would know. It's generally based upon pronouncements and chaos. It offends long-term allies. It's driven away some of our best friends. There's the argument in the morning, the retreat in the afternoon, and the declaration of victory in early evening.
The congressional hearing focused on the Trump administration's escalating tariff framework ahead of broader trade negotiations expected to intensify through 2026. Jamieson Greer attempted to argue that the administration's aggressive tariff posture was rebuilding American industry and forcing trading partners into concessions. But Democratic lawmakers repeatedly challenged the logic behind the policy, especially as pressures continue spreading through the U.S. economy. Several members pointed directly to sectors already feeling strain from cross-border disruptions. Auto manufacturing costs remain volatile. Construction inputs linked to Canadian materials continue facing upward pressure. Agricultural concerns are growing as fertilizer and supply costs remain elevated. Lawmakers also questioned whether the administration underestimated Canada's ability to adapt. That question matters because Canada did not respond to Trump's tariffs with panic. Ottawa responded with redirection. Prime Minister Mark Carney's government accelerated trade outreach toward Europe and Asia, expanded strategic discussions around LNG and critical minerals, and pushed investment policies aimed at reducing Canada's long-term exposure to Washington's political volatility. The hearing unintentionally exposed a growing fear inside parts of Congress. What if the United States triggered an economic confrontation that Canada is learning to navigate better than expected?
What we're paying for gasoline, what we're paying in the marketplace, what people are paying for fertilizer, it is driving considerations that heretofore would have been resolved in an amicable fashion. This damage is not theoretical. Jobs have been lost, supply chains have been disrupted, and last year there was really very little growth in job opportunities for the American people, with the exception of health care, which will be felt after the November elections, as well as it relates to our hospitals. Families are paying more.
The core problem facing the White House is simple. Tariffs are easier to announce than to contain. On paper, tariffs sound like pressure against foreign governments. In reality, integrated supply chains mean the economic shock often circles back into domestic markets. And Canada is not just another trading partner. The Canadian and American economies were built over decades to function together in energy, auto manufacturing, aerospace, agriculture, metals, and industrial production. Trying to suddenly politicize that system creates friction everywhere at once. That friction is now becoming visible. American manufacturers are dealing with higher input uncertainty. Construction costs remain sensitive to Canadian materials. farmers are still dependent on Canadian potash and energy-linked supply chains. Even U.S. refiners remain deeply reliant on Canadian crude because many facilities are designed specifically for heavy Canadian oil. Congress understands this. That is why lawmakers during the hearing kept returning to the same issue. If tariffs are supposed to strengthen the American economy, why do so many American sectors still appear structurally dependent on Canada? That question is politically dangerous because it undermines the entire easy replacement narrative.
One reason the Trump administration appears increasingly frustrated is because Canada stopped playing defense. Under Mark Carney, Ottawa has gradually reframed the dispute as a long-term restructuring project rather than a short-term trade fight. Instead of matching every American escalation headline for headline, Canada focused on making itself harder to pressure. That strategy is showing results. Canada's LNG sector is attracting stronger international attention as Europe seeks stable, non-Russian energy sources and buyers look for politically reliable suppliers. Canadian critical minerals are becoming more valuable as Western governments race to secure battery and defense supply chains outside China. At the same time, Canada is strengthening ties with Asian and European partners precisely when many countries are becoming uneasy with Washington's increasingly unpredictable trade posture. This is the irony Congress accidentally exposed during the hearing. Trump's tariffs were designed to pull production and leverage back toward the United States, but in practice, they are also encouraging allies to diversify away from American political risk. And Canada is positioning itself as the alternative. Not louder, not bigger, just more stable. That is a powerful message in a volatile global economy.
The hearing also revealed something broader happening inside American politics: tariff fatigue. Back in Trump's first term, tariffs were often framed as a bold negotiating tactic with manageable side effects. In 2026, the situation feels different because Americans are already exhausted by years of inflation, high borrowing costs, and economic uncertainty. Now add rising trade friction on top of that. The political problem for the White House is that consumers rarely separate inflation into categories. They do not care whether higher prices came from tariffs, shipping disruptions, commodity volatility, or supply chain friction. They just see costs rising again. That creates pressure on lawmakers, especially in industrial and agricultural states tied closely to Canadian trade. A senator from a farming state does not view Canadian potash as an ideological issue. They view it as fertilizer costs. A manufacturer in Michigan or Ohio does not care about trade slogans if industrial inputs become more expensive and contracts become less predictable. And this is where Canada gains leverage, because Ottawa is increasingly presenting itself internationally as the calm actor responding to American escalation. The more Washington intensifies the tariff rhetoric, the easier it becomes for Canada to look economically disciplined by comparison.
The hearing exposed one fear that few in Washington openly admit. What if Canada becomes less dependent on the United States faster than the United States becomes less dependent on Canada? That possibility changes everything. For decades, Washington assumed economic gravity guaranteed Canadian alignment. But global energy demand, critical minerals, Arctic trade routes, AI infrastructure investment, and geopolitical fragmentation are giving Canada new strategic importance beyond the American market alone. Canada is no longer just the neighbor. It is becoming a resource, energy, and infrastructure platform that multiple global powers increasingly want access to, and that reality weakens the effectiveness of pure tariff pressure over time. Congress may not have intended to highlight that shift, but during the hearing, the cracks in the old assumptions became impossible to ignore. Jamieson Greer entered Congress expecting to defend Trump's tariff strategy as a show of economic strength. Instead, the hearing exposed growing anxiety inside Washington itself, not because Canada launched some dramatic retaliation overnight, but because the underlying math is changing. The more tariffs disrupt integrated North American supply chains, the more American consumers and industries start sharing the pain. Meanwhile, Canada is adapting faster than many in Washington predicted. It is building new trade relationships, expanding strategic sectors, positioning itself as a stable supplier in an increasingly unstable world. And now, even parts of Congress are beginning to realize something politically uncomfortable. Trump's tariffs may be pushing Canada away far faster than they are bringing America back together.
And a tremendous tariff on lumber and things as such. And yet we don't need their lumber. We have more lumber than they do. We don't need Canada's lumber.
Tariffs are, in the end, taxes, and somebody has to pay that tax. And in this case, that tax will be paid by the buyers of that lumber, which is the home builders primarily, and the people who buy those homes.
There's already a serious shortage of affordable housing in many parts of the United States, including here in Southern California. The tariffs, by reducing supplies and increasing the prices of building materials, will likely make that problem worse.
Trump's tariffs were supposed to weaken Canada's lumber industry. Instead, they are forcing Canada to rebuild it, while the crisis in the United States is getting worse. What looks like a simple trade move on the surface is now reshaping one of the most critical supply chains in North America. The U.S. is trying to push production inward, but instead it is triggering higher costs, tighter supply, and growing pressure inside its own housing market. At the same time, Canada is being pushed into a transformation it didn't initially choose, but is now accelerating. This is no longer about who wins a trade dispute. It is about who adapts faster under pressure and who ends up paying the price in the meantime. Since returning to office, President Donald Trump has expanded tariffs across key sectors, including Canadian softwood lumber. Combined duties, built up through anti-dumping and countervailing measures, have pushed effective rates into ranges that significantly disrupt trade. For decades, Canada's lumber industry was built almost entirely around the U.S. market. Close to 90% of exports flowed south, and even the technical standards of production, down to measurement systems, were aligned with American demand. That system is now breaking. Prime Minister Mark Carney's government has responded with a mix of emergency support and long-term industrial policy. Financial aid is stabilizing companies in the short term, while broader investments are pushing the industry towards diversification and modernization. What we are seeing now is not a temporary disruption, but the beginning of a deeper shift in how the industry operates. Canada's lumber industry didn't just sell to the United States, it was designed for it. Mills were calibrated to produce standardized sizes like 2x4s and 3x8s, matching American construction norms. Supply chains, logistics, and pricing models were all optimized for one dominant customer. This created efficiency, but it also created structural dependence. When one market defines how you produce, it inevitably shapes how you invest, how you scale, and how you respond to shocks. For years, that relationship worked because demand was stable and predictable. But once tariffs entered the equation, that stability disappeared. What had once been an advantage quickly became a vulnerability, forcing Canada to confront how exposed its industry had become.
The immediate impact of tariffs has been disruption. Orders have slowed, margins have tightened, and in some regions, mills have reduced output or shut down altogether. Workers have been laid off, and communities tied to forestry are feeling the strain. But the deeper impact goes beyond short-term pain. To access new markets in Europe and Asia, Canadian producers must fundamentally change how they operate. That means shifting from imperial measurements to metric standards, redesigning product specifications, and upgrading machinery that was originally built for the U.S. market. These adjustments take time and capital. Retooling a facility can cost millions of dollars, and new equipment often comes with long waiting periods. This is not a quick pivot that can be executed in a single season. It is a multi-year transformation with real financial and operational consequences. Yet, despite those costs, the shift is underway. The pressure from tariffs is not just disrupting the system, it is forcing it to evolve. Even under pressure, Canada is not standing still. Producers are beginning to reposition themselves for new markets, particularly in Asia and Europe, where demand for sustainable and high-quality wood products continues to grow. At the same time, the federal government is reinforcing that transition. Financial support is helping companies navigate the immediate shock, but the broader strategy is focused on long-term competitiveness. Investments in mass timber, prefabricated construction, and low-carbon materials are gradually moving the industry toward higher-value segments. What ties these efforts together is a shift in mindset. Canada is no longer treating exports to the United States as the only path forward. Instead, it is building a more balanced model, combining domestic demand with diversified international markets. That approach does not eliminate the challenges, but it changes the trajectory. Canada is no longer locked into a single system. It is actively building alternatives.
While Canada is undergoing this transition, the United States is dealing with the immediate consequences of higher costs. Tariffs have not produced a rapid expansion in domestic lumber capacity. They have not removed reliance on imports. Instead, they have raised input costs across the construction sector, feeding directly into housing prices. Recent data shows just how quickly this pressure is building. By early 2026, U.S. homebuilder sentiment had fallen to a 7-month low, with more than 60% of builders reporting rising material costs and over 70% struggling to price homes effectively. At the same time, tariffs on lumber and related products, combined with earlier duties already near 35%, have pushed total effective costs significantly higher across the supply chain. Industry estimates suggest that tariffs alone can add between $7,500 and $10,000 to the cost of a single-family home, compounding an affordability crisis already driven by high interest rates and limited supply. Over a longer period, building material costs in the U.S. have surged more than 30% in just a few years, translating into roughly $10,000 or more added to new home construction. The timing makes this even more significant. The U.S. housing market is already under pressure from elevated interest rates and a persistent shortage of supply. Higher material costs add another layer of strain, making it harder for builders to complete projects and for buyers to afford them. The result is a market that becomes more constrained over time. Projects are delayed, costs are passed on, and affordability continues to deteriorate. What was intended as a protective measure is now contributing to a broader economic challenge.
What emerges from this situation is a clear asymmetry. Canada is paying a price, but that price is tied to change. The industry is being pushed to adapt, to diversify, and to move into higher value segments. The transition is difficult, but it is moving the system in a new direction. The United States is paying a different kind of price. It is not undergoing the same level of transformation. It is not rapidly building new capacity or restructuring its supply chains. Instead, it is absorbing higher costs within an unchanged framework. Over time, this difference becomes more important. One side is becoming more flexible, developing new markets and new capabilities. The other remains dependent on the same inputs, only at a higher cost. That imbalance does not show up overnight, but it builds gradually, and once it reaches a certain point, it begins to reshape the relationship itself. Trump's tariffs were designed to pressure Canada into concessions and bring production back to the United States. But the outcome is more complex than that. Canada is being pushed into a long-term transformation, one that reduces its reliance on the U.S. and expands its global reach. It is upgrading its industry, diversifying its markets, and strengthening its domestic base. Meanwhile, the United States is facing rising costs, persistent supply constraints, and a housing sector that is becoming increasingly difficult to stabilize. This is not a clean victory for either side in the short term, but the long-term direction is becoming clearer. Canada is changing, and that change is building resilience. The United States, for now, is absorbing the costs without fundamentally altering the system that created them. Trump's tariffs were meant to weaken Canada's lumber industry. Instead, they are forcing it to evolve into something more flexible and less dependent. That evolution is not easy, and it is not without cost. But it is moving Canada toward a more diversified and resilient position in the global market. At the same time, the United States is facing the immediate consequences of its policy: higher costs, tighter supply, and a housing market under growing pressure. So the real question is no longer whether tariffs can force change. It is who is actually changing, and who is simply paying the price.